Disaster is coming. I'm your host, Steve Van Metre, and thanks for joining me today. And legendary hedge fund manager Michael Burry is back in the news, warning investors it's going to be worse than the great financial crisis. And why does he think that? Let's head over to Insider to find out. With this headline, big short investor Michael Burry says the U.S. government is backstopping markets and the economy and warns too much fiscal support will end in disaster. Michael Burry called out the U.S. government for backstopping financial markets and the economy, warning that too much stimulus would ultimately lead to a devastating downturn. With recent spending bills, including the student loan forgiveness, now approaching $2 trillion this year, we have the emergence of the fiscal put. The investor of the Big Short fame tweeted on Thursday, and he's got a point because we investors believe in the monetary put, the Powell put, that central banks are going to prop up asset prices. But with inflation raging, central bankers have no choice but to tighten up monetary policy, now putting all of this burden on the fiscal side. And Burry's just calling out what he says is now the fiscal put, this time coming out of Washington. And he's saying that the government is functioning as a put option for investors by attempting to limit their potential losses. It's not just for COVID anymore, he says. It will be as good for America's economy as sugar babies, he added, implying that fiscal support may stave off declines in asset prices and economic growth in the short term, but it will inevitably result in a worse crash down the line. And that's a valid point, because when you pump up the economy, whether it's through fiscal stimulus or through monetary stimulus, and you pull it out from underneath, well, eventually it comes crashing back down to whatever level it needs to. And that's what he's saying is we're just postponing the inevitable by continuing to pump this up more and more. And eventually it's going to have a bigger crash that's going to come. And we can see that in the data. And why is the government so afraid? Because they understand that the stock market is the economy. And here on this chart, we have the Wilshire 5000, the total U.S. stock market on a year-over-year rate of change against the gross domestic product, or GDP, on a year-over-year rate of change. And we can see that red, the stock market, leads the economy lower. And they're afraid because the stock market's been heading down, and the fears are it's going to continue to plummet. And then without any monetary stimulus left, and with the fiscal spigot almost dried up, there's nothing left to hold this thing up. They're getting desperate. They need the market to stay up. But reality is, it's probably not. The Scion Asset Management boss has repeatedly voiced his concerns about excessive monetary and fiscal aid. In April, he highlighted the trillions of dollars pumped into the economy during the pandemic in the form of stimulus checks, cash-out refinancing offers, forgivable loans, and indirect support. He questioned how consumers could possibly fill the void in their finances left by those programs, ending in lending standards tightening, as higher wages wouldn't be enough. And he's got a good point, because when you look at this next chart, you can see the outlier in the income. And with this very obvious, when you look at average hourly earnings, they shot up during the pandemic. And again, this isn't adjusted for inflation. This is average hourly earnings just went way out of line, and people started spending based on this big move. And now what happens, wages are back within their kind of normal trend, and that leaves a huge void. The fund manager is taking aim at the Federal Reserve as well. He claimed the central bank was addicted to stimulus and has accused it of raising interest rates and shrinking its balance sheet, not to curb inflation, but to ensure it has scope to shore up asset prices in the economy when stocks and consumer spending slump. But is there any evidence to that? Well, there's some, because what we're seeing here in this chart is the monetary base, or the Fed's balance sheet. And the Fed is now aggressively starting to unwind this starting next month, and it won't be till the 15th where we start to see the first of this big change. Is quantitative tightening is going to double now to about $95 billion a month. Again, the two times they sell off are the middle of the month and at the end of the month, so we won't really see any of this till the middle of September. But note how asset prices are likely following this down. And we used to not have a strong correlation with the Fed's balance sheet and asset prices, but these days we do. And as the Fed continues to unwind and contract their balance sheet, well, lo and behold, the stock market is going to head lower. But one thing that shouldn't be going down with that is your portfolio. I'll put a link up here in the for portfolio show in the corner and description below, because Burry goes on to say that American households are facing higher food, fuel, and housing costs, leading them putting away less money each month, tapping their savings and loading up on debt. Consequently, he says they're on track to virtually exhaust their savings by Christmas, which will have a devastating effect. And we can see here the personal savings rate in blue against the consumer credit card and other revolving plans, total loans at all commercial banks. That one on a year-over-year rate of change in red. And note, as savings rate declines here in blue, what happens? Americans take on more debt to maintain their lifestyle, and ultimately it leads to a recession. And here we see it again. Americans now taking on more debt as their savings rate declines. Burry saying that by December they're tapped out, and of course we know those jaws will eventually close with, of course, a recession coming, and then of course the pay down of debt that comes with that. And of course we also can look at what this means for the consumer price index. Here we see the personal savings rate again in blue, now overlaid with the consumer price index in red on a year-over-year rate of change. And note, of course, when personal savings go down, they tend to happen during periods of higher rising and higher inflation, but eventually those jaws close, and what happens is the personal savings rate goes up and inflation starts to come down. And what is happening there is consumers are just spending less, they're paying down their debt, they're rebuilding their savings, and when that happens, inflation comes down. And we can see those jaws here again as blue, savings rate going down, inflation going up. Eventually those two equalize, and as a result, the Sion boss expects consumer demand to flag, and he's right, and retailers to cut prices to get rid of excess inventory, dragging down company earnings, economic growth, and inflation in the coming months. But is he right? Well, he is, because when we look at retailer inventories in blue and overlay corporate profits after tax in billions of dollars, what we see is that when inventories start to go down, what happens to corporate profits? They either flatten out or they go down. And why is that? Because when you have to cut the price of your inventory, your profits go down. We can see that happening and likely to happen again. And as far as inflation goes, the same thing occurs, because when you have to cut prices to clear your inventory, lo and behold, what happens to inflation? Now showing the consumer price index in red on a year-over-year rate change overlaid against retailer inventories, we see inflation come down, we see inflation come down, and we can see it come down a third time. And we can expect now again, because of course, as you see, retailer inventories are at record high levels, and we're going into a global slowdown, and only suggests that all of this inventory is going to have to get heavily marked down and discounted. It's going to take some time. It's going to have a big impact on corporate profits and of course equity prices. And there's more to support the big guy's view, as Burry does not talk about consumer sentiment, but there's a big factor as U.S. consumer sentiment rises to 3-month high on easing prices, as inflation expectations in the year ahead dropped to 4.8% in August. The University of Michigan's final sentiment index climbed to 58.2, the highest since May, likely because the stock market's back up from 51.5 in July. The figure beats all estimates of economists who called for a median reading of 55.5, but the real data here is future expectations rose. Again, a bit of a correlation here between that and the stock market, and you can see the gauge of current conditions rose to a 3-month high of 58.6, but wasn't up that much. A measure of expectations posted the sharpest monthly improvement since 2003, rising to the highest since April. In addition, personal financial expectations rose 12% from the prior month, again on the backs of a rising stock market. But consumers expect prices will climb at an annual rate of 2.9% over the next 5 years to 10 years, believing that this inflation story isn't going away. But they see costs rising only 4.8% over the next year compared to July's 5.2, suggesting that inflation is indeed starting to come down. And looking at the Wilshire 5000, again, the total U.S. stock market on a year-over-year rate change against consumer sentiment, you can see that in periods where consumer sentiment is tanking and staying low, the stock market continues to fall. We see this happen over and over again. And right now, consumer sentiment is nearly at a historical low, and the belief is it can't go lower, but if it stays down here, that means stock prices are indeed going to continue to fall. And when it comes to inflation now, looking at the University of Michigan consumer sentiment data in blue against consumer price index, you'll note that in periods where consumer sentiment is crashing, eventually you see inflation come down. You see sentiment falling, inflation falling. And why does that happen? Well, the key here is when people do not feel good about the economy, what don't they do? They don't go out and spend. So you go back to that other chart, what happened to personal savings rate? It starts to go up. You see inventories going down because retailers are cutting, and it's just a lack of confidence. And again, anytime that we don't feel good about our finances, we cut spending. And that is what we're seeing here in the data, saying that consumers aren't that confident. And the longer they stay unconfident about the economy, well, the worse it gets. And that means inflation comes down. And that's what we can tell with some relative good knowledge here, that this move down in consumer sentiment will eventually lead to a decline in inflation. And adding to that inflation drop, we see inflation expectations in blue that also tell us that interest rates are likely to come down, which isn't a popular view, but you can see as inflation expectations trend lower, inflation or interest rates fall, and you see it happen over and over and over again. And now we're starting to see the peak here in inflation expectations, suggesting that the peak in rates may be here. But what really is driving inflation expectations, as we talked about on the show, is gas prices. So now when we look at gas prices against Treasury yields, 10-year Treasury yields, both on year-over-year rate of change, you'll note that they tend to kind of move together. That as gas prices fall, so too do Treasury yields. And there are times when yields are falling and gas prices are rising, only to tell us that financial conditions were tight, and we see gas prices come down. We can see here that gas prices were falling as rates were trending higher, and that led to a hard reversal in rates and a drop in gas prices. Here we see gas prices peaking and looking like they're headed down. Rates still pushing higher, all suggesting that rates are going to come down. And it makes perfect sense, because lower rates mean financial conditions are tightening. When financial conditions tighten, you tend to have a recession. And that tells us that Michael Burry's sentiment about this big buildup in fiscal monetary stimulus and that rug pull that's following is only going to lead to a much bigger crash, when investors right now, if you can believe this, or have a much higher equity concentration in their portfolio than they've had in decades. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.